Hi, my name's Daniel Major. I'm the CEO of Goviex Uranium, and I'd like to give you a short presentation just to outline what our company does, and hopefully of interest that you'll come and see me in my virtual booth to come and have a conversation. So Goviex has been in Africa since 2007. We have one of the largest mineral resources in uranium. We have considerable exploration upside, but the key to our properties is that two of our properties are actually fully mine permitted. So if you believe in the uranium market improving, you're looking for companies that can convert their assets to cash flow, then Goviex is one of those. I will make a point from a value point of view. In the 2007 uranium cycle, the two companies that massively outperformed the sector during the rising uranium price were the two companies that were able to build mines and go from developer to producer during that cycle. In the 2011 uranium cycle, three of the largest takeout transactions were all completed in Africa as companies focused on nuclear development wanted to secure their rights to uranium assets. So just very briefly, as I said, all our projects are in Africa. We like Africa as a jurisdiction. We have very good mining codes. We're in mining countries, and in particular in the case of Niger, which has been exporting uranium since 1971, and uranium is 60 to 70% of its annual exports. This is obviously a country that understands and respects uranium mining. Just very briefly on the market, because obviously any investment into a sector is generally driven by market fundamentals. The WNA in September of last year put out their latest forecast, and I draw your attention first to the black line at the top. That is their forecast on demand. And then the two blue bars stacked up. That is existing assets and secondary supplies, and clearly shows an ongoing supply deficit is developing in the uranium market. This is further highlighted and it's been expanded by the impact of COVID-19 and the impact on supply demand coming through, particularly from the closures by Cameco and Kazatomprom. And that's highlighted in the top graph by the black bar, where suddenly we've got a breakout in the deficit, and that expands. The problem is, to replace a new mine and bring new mines on needs considerably higher uranium prices, as the cost curve on the top right-hand side shows that we're looking at least $60 to bring on 90% of the world's supply. And as we move forward in the industry as well, 80% of material is actually purchased under contract, but contracts uncovered are expanding, and the suppliers at the moment are unwilling to contract at current prices and are demanding much higher prices to achieve that. So we are looking forward, and we're seeing prices already tightening up. We've gone up $10 since March of this year, and we expect further advancement in the price during the rest of 2020. So where's Goviex in this? Goviex strategy is to become a developer. We have those permitted projects. So our intention is to advance the Madaouela Project in Niger first, and then follow that with the Matanga Project in Zambia. Madaouela is 80% owned by Goviex and 20% owned by the government of Niger. It's right in the middle of the uranium mining district in Niger. We are next door to Orano's mines at Cominac and Zambia. Importantly for us and global supply, Cominac closes in March of next year, reducing Nigerian exports by 50%. So obviously there's a lot of interest by the government and support by the Nigerian government to get Madaouela up and running as an operation. One of the benefits of being next to two operating mines is all the infrastructure is there: roads, power, water. And with Cominac closing, a fully trained workforce is available who's used to mining in uranium. The numbers I present here are for a project that was set out in 2015. It showed we would have a 21-year mine life, producing just under 3 million pounds per annum at a cash cost of $24 a pound. What Goviex has been doing since then, though, is looking at optimizing that and further reducing the operating costs. We've set out ourselves a benchmark of making sure that this project will work at less than $50 uranium under contract, and we're looking at improving its bankability, taking out technical and operating risk where we can see them, and structuring the project to make it as credit easy as possible. We had already started engaging with credit facilities, particularly the export credit agencies, and they found that Niger is credit worthy and it is worth investing in. We had also started initial discussions regarding offtake. And that is one of the reasons why in this, going into the second half of this year, we will produce a brand new PFS. This will allow us to re-engage those credit parties and the offtake parties, and hopefully be able to show to them we have a project that is ready, permitted, and works at less than $50 uranium. One of the benefits that Goviex also has is it has a second project. So while many of our peers out there have uranium projects, Goviex has the advantage of having more than one project. So we have the Matanga Project. It's down near Zimbabwe on Lake Kariba in Zambia. We have 140 kilometers of strike length here, but importantly, 3 mining permits interconnected. Again, a lot of exploration upside. This is a low capital project, slightly higher operating cost, but its break-even cost for this one is actually lower than for Madaouela. We do Madaouela first in Niger because it has the lower operating cost, but a very simple project. So if we see the continued extension of the uranium market, improvement going through, and we get Madaouela up and running, Zambia would be the next project on our pipeline. In addition to this, we actually have the Falea Project, and I won't put a slide up, but there is one on our slide deck on our website if you want to see it. Very interesting project, surrounded by gold properties. In fact, we have gold on one of our 3 licenses. It's a advanced exploration project that went all the way to PFS. So 3 very advanced projects in a very interesting pipeline going through. We have an experienced management who've been in the uranium industry or the mining industry for well over 25 years for most of us. And we have a board. Just out of, I think you need to point out here is that Govin Friedland is the founder of our company. He is the son of Robert Friedland. So the company comes with a long pedigree within the industry. We have David Cates, who's the director of Denison Mines and UPC as well. And importantly, Benoit Lassalle, who's the chairman of the Canadian Council for Africa. He's also the founder of SEMAFO. So has a very good reputation and understanding of people in West Africa. The company has had a long history with its sponsors, being Denison, Ivanhoe, and Cameco. We currently have about $1 million of cash. We have a debt on our balance sheet, but this debt is not due until 2022, middle of, and relates to a decision by the Nigerian government to defer all our tax payments until that date to allow us to continue to advance the project going forward. So just back to my comment earlier on in the presentation, all uranium companies should rise with the uranium price. The difference you're looking for are those that can find that extra leverage. And in our case, we are looking to move from developer to being producer and get that additional re-rate. And we're advantaged by having our mining permits already in place, unlike many of our peers. And I will just remind you at this point again, in the last cycle, the 3 biggest transactions were in Africa, where multinationals were looking to acquire long-term supply and can have control over it. So just summarizing, large resource, management are already there, a lot of exploration upside, permitted projects, and a focus on development. Thank you very much, and hopefully I'll see some of you at our virtual booth.